Chairman, fellow guests, I'd firstly like to thank Michael Summers for his kind words initially, and then Aidan Smith for his overpowering introduction. It's very good to be with you. The Ireland-US Council is known very well in Dublin in particular, but also throughout the country, for the excellent work you have done to promote Irish-American relationships. I think it's interesting to note that it was founded back in 1962 to prepare for the visit of JFK to Ireland. And I think for those of us who were young at the time, the visit of JFK to Ireland and his subsequent assassination were seminal moments in our young lives. And I can still see Arlington Cemetery and the young Irish Army officers doing the military honours on that sorrowful day. But tonight is a time for festivity, so I'd like to wish you a happy Christmas. It's lovely to see such an elegant room and such a fine Christmas tree, and everybody so festive. I hope I'm not the Black Santa visiting you. So sometimes it feels a bit like that. So I just have a few thoughts to share with you. I go to America quite a lot. I've got an American daughter-in-law, and I've got two grandchildren, little girls who are American citizens. They're out in North California. So we're over and back quite a lot. And we appreciate very much what the friendship with the United States of America has done to benefit Ireland in many ways, socially, artistically, but I suppose we think of it principally on the influence on the economy, particularly through the strong stream of inward investment that continues. And it's essential to our recovery plan because the Irish business plan is dependent on export-led growth. And to a large extent, the companies who have come in from the United States are the drivers of that growth, certainly in the first instance in building up the economy. So in that context, I want to tell you that the 12.5% tax rate is not up for renegotiation. That's a fixed platform of our economic policy, and it will stay that way. And it's interesting to note as well that despite the speculation in the media in recent weeks about it once more, that there's no reference to it in either President Van Rompuy's paper or in the joint paper from Messrs. Merkel and Sarkozy. No mention whatsoever. They do mention the topic that is the subject of a policy paper from the Commission, the possibility of a common tax base for corporate tax. But that has been filed now for some months by the Commission, and we'll participate constructively in the discussion on that. With my own networking, every one of the 27 countries, even those who speak loudest about it, have difficulties with it. So I don't see an early resolution to that. Our general policy for growth in the country is to concentrate initially on the sectors that are doing best. And that was the way the budget was framed, to try and get more growth, more play, more jobs out of the successful sectors of the economy. And we did a couple of things to further enhance the IDA package with which many of you would be familiar. Something people have been looking for quite some time. We've brought in a special assignee scheme with tax breaks attached. You know, the argument that if just one or two or three key people could be recruited from the outside, it would be the focal point for further growth and further jobs. We're doing that. It will be enshrined in the finance bill. As well as that for the BRIC countries, we want to incentivize those patriots who go out and knock on the doors in China and India and Brazil and try to get new business for their companies. And again, for 60 days every year, we give them the tax break for that activity to enhance that. So this is what we're doing. We're trying to take what's successful and nuance it and tweak it and get more out of it. Just after we went into government in May, we did something similar for the tourist industry. We dropped the VAT rate from 13.5% to 9% on all the tourist products, whether it's beds in hotels or meals in restaurants or green fees and golf courses. But we focused it narrowly on the hospitality sector. And it has had a result. Figures went up over the summer by almost 11%. And we'll follow that next year, and we'll drive that harder, because tourism is a great industry, and we must be very strong on it. And curiously, if you look at the strained times we're in, it's an industry that doesn't really require investment, because we have more hotels than we can fill. We have more golf courses of a high standard that there are golfers to play. We have the road network in place now. We have the terminals in the airports that could take a lot more traffic. So it doesn't require a lot of investment, but it does require people to come and see this beautiful country and participate in the very good lifestyle that we still have in this country. So we drive the tourist industry as well, and a lot of American tourists came in this year. Figures were up. We hope it continues and that the Americans return again as they used to play the golf or fish in the rivers or just drink a pint and, connect with the Irish charm, if that's the correct way to put it. Our budgetary position is online. I'm sure you're familiar with the situation with the European authorities and the IMF. Effectively, we're in a contract, and we have a memorandum of understanding with a series of conditions set down. And every quarter, they come and they tick the boxes to see have we fulfilled the conditions. And if we have fulfilled the conditions, they disperse more money to us. Today, actually, the IMF dispersed a lot of money to us because they operate separately from Europe, and they have their own meeting in Washington. They go through the box-ticking exercise as well. So we're doing all that, and we're fulfilling our obligations. And at present, Ireland is a success story in Europe. But there's a long way to go until we get our deficit down below 3% by 2015. Europe has been in difficulty for some time now. And the story of the euro has dominated world economic commentary. But the euro actually has been a very successful currency. The problem isn't with the euro as a currency. The problem is in certain areas or countries in Euroland or in the eurozone. The euro is stronger now than it was when it was brought in 12 years ago. It's gone up in value. The euro has increased European trade by 50%. The euro has been a better hedge against inflation than the Deutschmark was, because the average inflation over 12 years has been less than 2%. And the euro is a world reserve currency. And when the Swiss 2 months ago were looking for a currency against which to benchmark, they didn't choose the dollar or the yen or go back to the gold standard. They benchmarked against the euro. So if the canny people in Switzerland still see a strong future in the euro, well, I think the euro is a currency one can rely on. But there are problems within the euro land. And certainly, too much was borrowed, too much was spent, and the burden of debt in Ireland and in other European countries has been too much. So the first thing countries in Europe have to do is sort out their own fiscal positions and sort out their own debt positions. And that's happening now, and it's happening with great rapidity. Sometimes you think, as you watch it play out, that there's nothing happening. But, new government with all-party support in Greece, new government with all-party support in Italy, new government with an overwhelming majority in Spain, new government in Ireland, we're in our 10th month, new government in Portugal. So you can see that the problem countries have changed politically and have changed their fiscal programs and have got a lock-in most cases, from the opposition as well as from the governing parties. So significant progress is being made. The next leap forward we'll have to do is to deal with the governance issue that's now being debated. And immediately after the heads meeting last week, technical and legal groups were put together to draft the new governance rules. And we're represented on that. It's too soon to say whether we'll require a referendum or not. I mean, you're familiar with the position here. If something requires constitutional change, it can only be done by referendum. In other European countries, you can do it by votes in Parliament, either simple majority or weighted majorities in Parliament. But There's no shortcut in Ireland. You have to do it. But it's not clear yet that we will require a referendum, because it's not clear and won't be clear until we see the text whether constitutional change will be required or not. But, you know, I'm confident in the future of the euro. I'm confident in Ireland's future within the euro, and we will work with our partners in Europe in working out solutions to these events. I would like to have a situation emerging over the next 6 months where all European countries with fiscal problems and heavy burdens of debt would be seen to be well on the way to dealing with those problems. I would also like to see a situation where the governance issues are put in place so that it's clear that it's not a fix for a couple of years, that it's a generational fix. And at that stage then I would hope that the European Central Bank might begin to act like the Fed does, or like the Bank of England does, and give us the firewalls that are necessary to make a full economic recovery in Europe, because that's absolutely necessary. So that's where we are. I wanted to share those few thoughts with you this evening. If you're optimistic about the economy, you know, I saw a lot of wine there when I was coming in, so drink up. If you're very bearish about things, well, there's a very simple piece of advice for the bears in the audience. You know, if you're being chased by a bear, you don't actually have to run faster than the bear. You just have to run faster than your friend. So thank you very much, and happy Christmas once more.